If you want to understand the true, devastating difference between public and private debt, not just in theory, but in human cost, you must look at the 1980s in Latin America. This era, universally known as the Lost Decade, was an economic catastrophe of biblical proportions, wiping out decades of progress, plunging millions into poverty, and forever reshaping global finance. Yet the crisis was not triggered by reckless spending in São Paulo or Mexico City. It was triggered by a torrent of unregulated aggressive lending from the largest U.S. commercial banks, fueled by a geopolitical anomaly known as the petrodollar cycle. This is the definitive chilling case study of how the Minsky moment, triggered by private financial excess, can decimate an entire continent. Our story begins in the aftermath of the 1973 oil crisis. When OPEC countries dramatically hiked oil prices, they were flooded with billions of newly acquired dollars, petrodollars, which needed to be stored somewhere safe. These vast sums poured directly into the largest, most trusted banks in New York and London. Suddenly, banks like Chase and Citibank were sitting on mountains of cash they needed to lend out to earn interest. This pressure to deploy capital led to a colossal failure of financial prudence. Instead of being conservative, these private banks engaged in a lending spree across the developing world, targeting sovereign nations in Latin America, Mexico, Brazil, Argentina, Chile, who were eager to fund massive infrastructure and industrial projects. Loans were often short-term, with variable interest rates, and minimal due diligence was performed. This was speculative finance on a sovereign scale, betting that these nations' commodity exports would forever keep growing to cover the obligations. This cycle of mutual recklessness was sustained throughout the late 1970s, as money flowed freely and interest rates remained relatively low. But the fuse was lit in 1979 by one man, Paul Volcker, then chairman of the U.S. Federal Reserve. Desperate to tame devastating inflation at home, Volcker made a dramatic, unilateral decision to radically increase the Fed's benchmark interest rate. The effect was immediate and globally catastrophic. Since almost all the Latin American loans held by the U.S. banks were tied to variable rates, the cost of servicing their debt instantly skyrocketed. A loan that was manageable at 5% was utterly impossible to repay at 15% or 20%. This single sudden move, the Volcker Shock, transformed the region's debt from manageable speculative finance into inescapable Ponzi finance overnight. The Minsky moment hit Mexico first. In August 1982, Mexico announced it could no longer service its debt. This single default triggered the full-blown contagion effect. Creditors realized that if Mexico couldn't pay, neither could Brazil, Argentina, or Venezuela, whose economies were similarly structured and leveraged. The U.S. banks, terrified of losing hundreds of billions, immediately froze all lending to the region. The flow of credit, the very lifeblood of the fractional reserve system, stopped dead. Without new loans to roll over old interest payments, default was guaranteed. The crisis spread like wildfire because it wasn't a public debt crisis managed by one government. It was a private debt crisis where commercial lenders simultaneously withdrew funding across the entire region. The consequences were a human tragedy. Capital flight became endemic. Inflation soared, sometimes reaching 4-digit percentages annually. Governments, shackled by the International Monetary Fund, IMF, and the World Bank brought in by the U.S. Treasury to stabilize the system and protect the U.S. banks, were forced to implement devastating austerity measures. They slashed social spending, privatized public assets, and prioritized debt repayment over basic human needs. The average person in Latin America saw their real income plummet, poverty rates double, and unemployment soar. For Brazil and Mexico, the 1980s was an entire decade of zero or negative growth, a true lost decade, all traceable back to the aggressive, risk-laden private lending decisions made years earlier in New York. The lost decade serves as a permanent chilling warning. It proved that the true structural danger to the global economy lies not in the noise of government deficits, but in the reckless deployment of private capital that is suddenly withdrawn. The crisis was solved not by the debtors repaying, but by the banks eventually being forced to restructure and write down the debt, often with public assistance, proving once again that the burden of private excess eventually falls onto the public. If this deep dive into financial history provides you with a crucial perspective on the hidden costs of reckless lending, I urge you to subscribe. That simple act of subscribing is your investment in the continued independent analysis that keeps you ahead of the coming cycles of excess and collapse. Next time, we will confront the moral dilemma that sits at the very heart of the entire debt cycle. We will ask the most uncomfortable question of all. Why do bailouts always punish savers and reward speculators? The moral hazard trap. We'll analyze why governments consistently choose to rescue the large financial institutions, thus guaranteeing that the cycle of boom and bust will repeat forever. Don't miss it.